Hi, welcome back, and we're ready to do module number 9. We're going to be discussing fixed assets, which is property, plant, and equipment. Before I do that, let me just go over on the board here what are the multiple choice questions that I want you to do. Now remember, you are supposed to do just the ones that I tell you to do. However, you have to do them my way. Okay. For module 9, the multiple choice questions that I want you to do is I want you to do numbers 1, 2, 3, 4, 7, 9, and 10, 11, 12, 21, 22, 27, 30, 35, 37, 38, 39, 46, 47, 48, 49, 50, 52, 53, 59, 61, 62, 64, 65, 67 and 68, 72, 77, 78, and 82. There are 15 keywords, which I will tell you next. There's 15 keywords. I also want you to do simulation number 1. I want you to do the entire simulation on pages 252 to 253. The solution is found on pages 266 to 267. So I want you to do the whole thing. Now for simulation number 3, so that's simulation number 1, do the whole thing. Now simulation number 3, I only want you to do the section on goodwill impairment. That section on goodwill impairment only is found on page 257, and the solution is found on page 274. And we'll probably do that one together. Okay, now let's first talk about the 15 keywords. The 15 keywords. Okay, the keywords are always found at the back. On page 242, get out your pen, and we are going to check off some questions for the keywords. On page 242, on the far left-hand column, I want you to check off acquisition cost, then boot, then capitalization of interest, then capitalized expenditures, then capitalized interest, then commercial substance, and then at the very bottom of the left-hand column, configuration of cash flows. So in the far left-hand column, it's acquisition cost, boot, capitalized interest, capitalized expenditures, capitalized interest. One was capitalization of interest, the other one is capitalized interest. Then commercial substance, again, configuration of cash flows. In the middle column, the fourth one down, depreciation, drop down some more, goodwill, then goodwill impairment, then impairment loss. So the four in the middle are depreciation, goodwill, goodwill impairment, and impairment loss. On the far right-hand side, far right-hand column, there's just a couple of them, intangible assets amortization, and then non-monetary exchange. So intangible assets amortization and non-monetary exchange. And I just want you to write down a couple more. That was only 13 of them. The two that I want you to write down are betterment, and then also extraordinary repair. Extraordinary repair. So when you add those two to the 13 I had you check off, those are the 15 keywords. Make sure you write down those two, betterment and extraordinary repair, because they're really not anywhere on here. Okay, that's what I want to go over then. Now, there is some new material, okay, in module 9. They happen to deal with standard number 157. As a matter of fact, standard number 157, which I'd already gone over with you back in module 7D, and that one specifically related to the Emergency Economic Stabilization Act. It was written into the act where they have to conduct a study, and the SEC can pull standard 157 at any time, but that's as it relates to financial assets and financial liabilities. Standard number 157 also relates to non-financial assets and non-financial liabilities. So we will be talking about the non-financial asset portion here of standard 157. When we get to that, it's only like one little paragraph in the entire module, but I will point it out to you. Then I'll do 3 multiple choice questions to show you how the multiple choice questions could be tested. Now we are going to be looking at their handout. We're going to be looking at the handout, pages 6, 7, and 8 of your financial accounting and reporting handout. So pages 6, 7, and 8. Now on page 8 of your financial accounting and reporting handout, I'm probably not going to cover this one. What I'll do is I'll just assign it to you. I want you to just read over on page 8 of your financial accounting and reporting handout. This happens to deal with accounting for software. And on the left-hand side, they have software developed for sale or lease. That's standard number 86. For that, I've assigned you multiple choice questions number 77, and 78. That's on the left-hand side, which is software developed for sale or lease under standard number 86. And on the right-hand side, we have software developed for internal use under SOP number 98-1. So that would be, that's an AICPA statement of position. 98-1, software developed for internal use. For that one, I want you to just do multiple choice number 82. So just take a look at the handout on the left side and on the right side of page 8 of your financial accounting and reporting handout, and just do these 3 multiple choice questions on it, okay? I've laid it out very nicely for you, comparing and contrasting one versus the other one. I always do that. The reason is because when I lay things out on a handout, it makes it so very easy that you can memorize one column, just memorize what's different in the other column next to it. That makes it easier to memorize the information for the exam. Okay, let's then go ahead and take a look at page 226. So beginning on page 220, I'm just like rearranging my handout here. On page 226, let's begin at the very top of page 226 for Module 9. Okay, letter A starts with the acquisition cost. Acquisition cost of property, plant, and equipment is very important. The reason is because it really depends what you capitalize and call as part of the asset as opposed to what you treat as an expense in the period. Whatever you capitalize and call as part of the asset will then eventually get depreciated, or in the case of land, will actually never get depreciated. So it's really important what you call the historical cost of the asset. On page 226, they start up at the top. Fixed assets represent the capitalized amount of the expenditures that are made to acquire tangible property, which will be used for a period of more than 1 year. Their cost, therefore, is deferred to future periods in compliance with the matching principle. Tangible property will include land, buildings, equipment, and any other property that physically exists. All of the costs that are necessary to get the asset to the work site and to prepare it for use are capitalized, including the cost of negotiations, sales taxes, finder's fees, raising an old building. Now, raising an old building, I know that sounds weird when they say they give that verb, raising, to raise, R-A-Z-E. This is synonymous with demolition, okay? So when you raise an old building on the land, that means demolition, and you're demolishing it, okay? You, like, make it flat, all right? What's important that you understand about raising an old building is that the cost of demolition or raising the old building is capitalized to the land. It's not capitalized to the new building that you build exactly on top of where the old building was. So the cost of demolition on the land are capitalized to the land, okay? Now, the cost of demolition are offset by any proceeds you receive from salvaged materials. Like when you demolish an old building, you might have some scrap metal, some scrap steel, some used bricks, that type of thing, used plumbing fixtures, that you can take all these scrap pieces of metal and sell it for salvage value, okay? So the proceeds from salvage do offset the cost of raising the old building or demolition. But the net cost of the demolition is capitalized to the land. It is not capitalized to the building. And that's important because land you do not depreciate. Okay, so to continue on, the costs that are capitalized includes the cost of negotiations, the sales taxes, the finder's fees, raising an old building, shipment, installation, preliminary testing, and so forth. So all costs that you incur in order to put the asset into use are considered to be capitalized to that asset. So you buy a new piece of equipment, let's just say it's an air conditioner. It's not just the invoice price of the air conditioner. It's also the shipping and handling costs associated with the insurance during transit. Okay, and let's just say you have an air conditioner that has to get put up by crane on top of the building. You're going to have to rent the crane. You're going to have to get a special permit to close the street so the crane can be there. And of course, you're not going to be doing this on a Monday morning. You're going to be doing this when? Over a 3-day weekend, which means you're going to have to pay everybody what? Overtime. So all the cost of labor, the cost of testing the equipment. If you have to build a special platform on the top of the building to carry the weight of that air conditioner, that's capitalized to the cost of the air conditioner as well. Okay, so all these costs then would be capitalized to that air conditioning unit. All right, so shipment, installation, preliminary testing, and so forth. When capitalizing such costs, it is necessary to associate them with the asset which is being prepared for use. Thus, the cost of raising the old building is added to the cost of the land on which the building stood. Charges for self-constructed fixed assets include materials, labor, and overhead. Those of you who had me for cost accounting in BEC already learned there's 3 types of production costs. The 3 types of production costs are direct materials, direct labor, and overhead. So if you're constructing it yourself, then the cost of material, labor, and overheads goes to the cost of the piece of equipment or the building. All right, and you have to include a fair share of their fixed overhead. Assets that are received through a donation should be recorded at their fair market value with a corresponding credit to revenue. If a fair market value is not determinable, the book value should be used. If an entity incurs a liability associated with the future retirement of the asset, the fair value or present value of that obligation should be added to the carrying value of the asset. See the outline of standard number 143. Now remember, in the very back of your textbook, there's an outline of every single one of the original pronouncements that could be tested on the CPA exam. It's not every single one, just the ones that they might test on the CPA exam. And do not go back there until I tell you to go back there. Okay, now it's time to go back there. So we're going to take a look at page 1009 because we need to go over standard number 143. Now on page 1009, which is in the very back, and we're going to be covering standard number 143. Okay. On page 1009, can you believe it? A book that actually has like 1,000 pages. On page 1009 at the very, very bottom, it says Statement of Financial Accounting Standards number 143, and it says A50. What does the A50 stand for? It stands for section A50 in your current text, and A50 is entitled Asset Retirement Obligations. Yeah, that's because we're doing accounting for asset retirement obligations. So that's where you would look it up. Asset retirement obligations in the current text. Either that or you would have to remember in the that you have a topical index, it would be under the A's for the assets. Or, if you find it easier, just memorize it's standard number 143. Now that's too hard to memorize, okay? Just do it based on the topical index. It's ordered just like an encyclopedia, like the current text. Now, what we have here, the bottom page 1009, it says, this standard provides guidance on accounting for obligations that are associated with the retirement of a tangible long-lived asset. Letter A says, the guidance applies to legal obligations associated with retirement of long-lived assets that result from the acquisition, construction, development, and or normal operation of a long-lived asset, except for obligations of lessees. Examples will include, number 1, cost to decommission a nuclear utility plant at the end of its useful life. Number 2 says cost to dismantle and remove an offshore oil platform at the end of its useful life. Okay, these are very, very good examples and classic examples of assets that will have asset retirement obligations. What does that mean? It means that you have this giant asset and it's a giant polluter and it creates things that have polluted and you have to clean up your mess, and all the costs of cleaning up your mess are going to be a liability for you. And the reason it's a liability is because the Environmental Protection Agency says you will clean up, or in the case of decommissioning a nuclear power plant, that would be the Nuclear Regulatory Commission, the government will say you must clean up your mess. And so the future costs have got to be added to the cost of the asset. And that increases the cost of the asset, which then also increases the depreciable base, which is the total amount that you can depreciate over the life of the asset. So, let's take a look at page 1010. Letter B at the top of page 1010. Such legal obligation arises from, number 1, the existing or enacted law, statute, or ordinance. Number 2 says a written or oral contract. Number 3 says a legal construction of the contract under the doctrine of promissory estoppel, meaning an inferred legal obligation. Letter C says an asset retirement obligation is recognized at its fair value in the period in which it is incurred, providing that a reasonable estimate of fair value can be made. So this is the fair value of all your future liability associated with cleaning up that dirty asset. Letter D says upon initial recognition of the liability, the entity will increase the carrying amount of the related long-lived asset by the same amount as that recognized for the liability. And letter E says the cost shall be subsequently expensed using a systematic and rational method over periods no longer than that for which the asset is expected to provide benefits. All that means is that you're going to add it to the cost of the asset, and it's going to increase the amount of depreciation that you depreciate. okay, because it increases the cost of the asset. Now, the journal entry you're going to make is a very simple journal entry. Basically, when you have the present value of that obligation, should be a debit to asset and a credit to some sort of a liability account. And that would be at the fair market value of the liability, so that's the debited and the credit amount. It's the fair market value of the liability, so you're going to debit the asset and credit the liability. And by debiting the asset, you bump up the cost of the asset, which is going to bump up its historical costs, and then you're going to increase the amount that you're going to depreciate. So remember that if you incur a liability associated with future retirement of this asset, and classic examples are cleaning up your mess from your nuclear power plant or from your offshore oil platform, okay, you have to add this to the carrying value of the asset at the fair value of the obligation or the fair value of the liability. So you have a future liability there. Okay. All right then. Let's see if we can take a look at some multiple choice. Remember that you must capitalize all costs that you incur in order to put the asset into use. All right. Let's take a look at multiple choice number 1 and 2, please. Number 1 and 2. Multiple choice numbers 1 and 2 are found on page 243. Numbers 1 and 2 on page 243. Now remember to always read the stem first. Isn't that right? What is wrong with my glasses? My glasses are dirty. Sorry. Cindy can't see. All right. Multiple choice number 1, which is found on page 243. Number 1 says, what amount should Mary record as the cost of the machine? The cost of the machine will be its historical cost. Number 1 says, Mary Company purchases a machine. It costs $125,000 for its manufacturing operations, and they paid shipping costs of $20,000. Mary then spent an additional $10,000 testing and preparing the machine for use. What amount should Mary record as the cost of the machine? Remember, it's all costs that you incur in order to put the item into use. So the machine has an invoice price of $125,000, so you'll capitalize $125,000. Then they paid some shipping costs of $20,000. Yes, the shipping costs that you incur will be capitalized. So that now brings it up to $145,000. Then it says Mary spent an additional $10,000 to test it and prepare the machine for use. Yes, you'd also capitalize the $10,000. So it'd be the $125 plus a $20 plus a $10. The total is $150,000, and that would be the historical cost of the asset. So what amount should Mary record as the cost of the machine? The total is $155,000. So the answer there would be A. Remember, you can choose A, but only if you're sure. Let's take a look at multiple choice number 2. Number 2 says, in its December 31st, 2008 balance sheet, Boyd should report a balance in the land account of what? So this is a little bit different because number 1 was a machine. Number 2 is going to be land. Now remember, the cost of raising or demolition of any old structure on the land will be capitalized to the land. By the way, also included in property, plant, and equipment would be not just the building and not just the land, but you also have things like land improvements. An example of a land improvement is a parking lot. Another example of land improvements would be things like sidewalks, okay? If you had to clear and grade the land, clearing and grading the land would actually be capitalized to the land because you're making the land flat and ready for use for construction. Other things that they might have is you have one of those above-the-ground parking garages, okay? An above-the-ground parking garage is considered to be a structure because it's not enclosed. If it were enclosed, then it would be a building. But since it's, open and the cold air can come in, that's considered to be a structure. And all these things have to be capitalized, and they could be all different because the land doesn't get depreciated, but the building does. The parking lot is a separate land improvement, so are the sidewalks, so is a parking structure, all right, the above-ground parking structure, because all of them might have different depreciable lives, okay, so you would have different lives used for depreciation. Even you can have all of them could be different depreciation methods. And also remember, inside the building, you have all kinds of things. For example, our board here, even though the building is considered to be real estate, this board right here is considered to be a fixture. A fixture was personal property which they permanently affixed to the real property in a manner such that if I remove the board, it would destroy the board, plus it would also destroy the real property. So that's called a fixture. Then we have a furniture. This is an example of furniture. My podium's here. This is furniture. So you have furniture, you have fixtures. Remember the building right here. The building behind the board is considered to be real property. Okay, let's take a look at multiple choice number 2. Number 2 says in its December 31st, 2008 balance sheet, Boyd should report a balance in the land account of how much? Number 2, On December 1st of 2008, the Boyd Company purchased a $400,000 tract of land for a factory site. Okay, so the purchase price of the land is $400,000. Boyd razed an old building on the property and sold the materials it salvaged from the demolition. Boyd incurred additional costs and realized salvage proceeds during December 2008 as follows. Okay, the demolition of the building cost them $50,000. All right, so you add that to the $400,000. Then they have legal fees for purchase, contract, and recording ownership. Yes, that would be capitalized to the land. Okay, that's recording ownership. Then you have title insurance. Yes, that would be capitalized to the land. And then you have proceeds from the sale of salvage materials, $8,000. Well, that would be an offset against a demolition of the building, because when you demolish the old building, you might have some scrap metal or used bricks, what have you, that you sell, and the cash that from selling those salvage materials offset the cost of demolition. So you take the $400,000, the net cost of demolition of the old building is $50,000 minus $8,000, which is $42,000. So you add the $42,000 to the $400,000, plus you add the legal fees. All right, always got to pay the lawyers for $10,000. Plus you also add the title insurance. That all gets capitalized to land. So it's 400 plus 42 plus 10 plus 12 is a total of 464,000. So the correct answer is A, 464,000. Remember, you can choose A, but only if you're sure. Okay, let's go back to the front of the module. And I don't know what it is. My glasses are still dirty. Back to page. Here I am trying to squint and see what the page number is. I can't read the page number without it. This is what I get for reading all these FASB accounting standards on page 226. About one-third of the way down the page, on page 226, we have capitalization of interest. SFAS number 34. Yep, an old one, but a good one. SFAS number 34 says see outline. We're not looking at that outline. This requires the capitalization of interest as part of the cost of certain assets. Only assets which require a period of time to be prepared for use qualify for interest capitalization. These include assets that you construct for sale, which is produced as a discrete project. For example, a battleship. Yeah, if you're making a battleship for the Navy. I almost said the Army, but they don't have battleships, do they? for the Navy. All right. Since that takes a number of periods, accounting periods to construct, you could capitalize the cost interest. And any assets that are constructed for our own use, whether by us or by an outsider. For example, if we're constructing our own building, okay, you're going to incur usually some interest associated with a construction loan. The interest on the construction loan for the building you're constructing for your own use, that interest will be capitalized to the building during the period of construction. So when you get the construction loan, you're going to incur interest. All that interest, when you credit cash to pay the interest, you're going to be debiting building construction in progress, or it's an asset account. Okay. Now what happens once the building is completed? Once the building is completed and you move in, all the interest payments you make on the construction loan then become interest expense, and they go in minus other expenses and losses. Remember that? We learned that when we were talking about Module 7D, and we did the multiple step income statement. I believe it was page, here I am disappearing because I have to go get my other book. In Module 7D, on the first page of Module 7D, on page 128, when we did the multiple step income statement, remember I told you when we did Module 7D that you had to memorize that, as well as you had to have a very good familiarity with the classified balance sheet on page 132. Remember that? I told you that in Module 7D. The interest expense, as soon as you move into the building, all right, you stop capitalizing, you put it in minus other expenses and losses on the multiple step income statement. Okay, remember interest expense goes there. But until that point, during the period of construction, you capitalize the interest. Why? Because that's what the accounting standard says. Okay. Usually the cutoff is when you're constructing your own building. Before they allow anybody to move into the building and use the building, they have something called an occupancy permit, and the occupancy permit is granted by the county government after they come and do their final inspection and make sure that the building isn't going to fall down and meets all the fire codes and all the building codes for construction and what have you. So as soon as you receive the occupancy permit, that's really the cutoff point when you stop capitalizing interest, and then you start expensing the interest and putting it in minus other expenses and losses. Now, there's two ways to capitalize the interest. They have your average interest, and then you have your actual interest. The average interest is based on the weighted average of the accumulated expenditures during construction. Don't worry, I will show you how to do that. Then you have the actual interest. So which one do you capitalize? The answer is whatever it is, you just pick the lower number, okay? Because we're talking about conservatism here. We also learned about conservatism in Module 7A when I discussed accounting theory. Conservatism means the accountant, when confronted with alternative methods of accounting treatment, do I capitalize a higher number? Do I capitalize the lower number for capitalized interest? We'll always still select the method which does not overstate assets and does not overstate net income. Since we're talking about an asset here and what we're calling part of the asset and capitalizing asset, we always choose the lower number. Whatever it is, the lower of average or actual interest. Let's take a look at a couple multiple choice on that. We're going to look at multiple choice questions number 3 and 4, please. Number 3 and 4. Numbers 3 and 4 are found on page 243. Number 3 on page 243 says, what amount of interest should Cole capitalize? By the way, if they try and trick you and say they have interest on that they have interest on a bank loan because they needed the bank loan to finance a purchase of merchandise inventory. Okay, so you're a retailer and you purchase merchandise inventory. That interest is all expensed. And the reason is because the inventory is ready for sale. Isn't that right? The only time you can capitalize the interest is when it takes a number of periods to construct or make something. If you buy something that's already ready-made that you're going to resell, the interest on that loan is not capitalizable. Number 3 says, the coal company, so they want to know what amount of interest cost should they capitalize in number 3. The coal company began constructing a building for its own use in January 2008. During 2008, coal incurred interest of $50,000 on specific construction debt and $20,000 on other borrowings. Interest computed on the weighted average amount of accumulated expenditures for the building during 2008 was $40,000. What amount of interest cost should Cole capitalize? Okay, so they're asking you, what do you capitalize? The $50,000, the $20,000, the $40,000? Well, first of all, you could ignore the $20,000 because the $20,000 says it's on other borrowings. Has nothing to do with construction. So it's just there to confuse you. So then you're left with, they incurred interest of $50,000 on the specific construction debt, and then they have interest computed on the weighted average amount of accumulated expenditures for the building during 2008 was $40,000. That's the average interest. So do you capitalize the actual interest of $50,000 or the average interest of $40,000? Doesn't matter. Pick whatever number is a lower number. So you're going to pick which number? $40,000. So the correct answer is $40,000. The correct answer is B, like Barbara. Okay? Next one, number 4 is a little bit harder. Number 4 says, what amount should Clay report as a capitalized interest at December 31st, 2008? The Clay Company started construction of a new office building on January 1st, 2008, and they moved into the finished building on July 1st, 2009. Of the building's $2,500,000 total cost, $2 million was incurred in 2008 evenly throughout the year. Clay's incremental borrowing rate was 12% throughout 2008, and the total amount of interest incurred by Clay during 2008 was $102,000. What amount should Clay report as capitalized interest at December 31st, 2008? Now, we do understand that the building was finished in July of 2009, but they want to know, what do you capitalize for 2008? Well, they gave us the actual interest. The total amount of interest incurred by Clay during 2008 was $102,000. And we have to take the lower of the actual interest of $102,000 versus the average interest. In this case, we're going to have to calculate the average interest. Okay, I'm going to have to erase this stuff. Now, you know, the review types this all up for you and puts it on a sheet. But, you know, me, I just have to, like, put something on the board. All right, but, okay. To calculate the average interest, what you're going to do is during 2008, when they started the construction, at the beginning of the year, the construction was $0. Then by 2008, by the end of it, it says that $2 million was incurred in 2008 evenly throughout the year. So at the beginning, it was $0. By the end of 2008, it was $2 million. So to calculate the average of those, you add them together and you divide by 2. So 0 plus 2 million is 2 million divided by 2. The average then is going to be 1 million. So these were the average expenditures. And then you're going to take the average expenditures, multiply that by the interest rate, which is 12%, and that's going to give you $120,000 for the average interest. So the average interest is $120,000. The actual interest is $102,000. Which number are you going to pick? The lower one. So the correct answer would be $102,000. The correct answer is A. You can choose A, but you have to be sure. Now, how is number 3 different from number 4? Well, number 3, which we just did, they gave you the actual interest of 50, and they gave you the average interest of 40, and of course you choose the lower number, which was 40. In that case, the average interest was lower. In this case here, though, the average interest of $120,000, this is multiple choice number 4, the average interest of $120,000 was higher than the actual interest of $102,000. Doesn't matter. Which number are you going to pick? You're going to pick the one with the lower number. Why? Because that's more conservative. Okay. All right, then. Let's go back to our notes. Now, of course, you know if I skip it, you can skip it, right? Okay. The next thing that we're going to work on is we're going to work on, oh, yippee, non-monetary exchanges. I have a nice handout I updated for you on page 6 of your financial accounting handout. So now that you have this asset, we're going to talk about all the things that we're going to do with the asset. We're going to go through a life cycle approach. The life cycle is first you acquire the asset, however you acquire it. You could buy it. You could construct it yourself. Then you might exchange it for another asset. You're also going to depreciate the asset. You're also going to have to spend more money on the asset. Finally, you'll dispose of the asset. So you turn to page 6 of your financial accounting and reporting handout. On page 6, we're going to discuss exchanging the asset for another asset. Okay, this is called a non-monetary transaction or a non-monetary exchange. What does non-monetary mean? Non-monetary describes the asset. Remember, when we were back in Module 7D, we discussed when we're talking about inflation-based accounting and current cost accounting, you have assets that are either monetary assets or non-monetary assets. Monetary assets are defined as cash, anything with the word receivable, like accounts receivable, notes receivable, held to maturity investments and bonds. Those are examples of monetary assets. A non-monetary asset is things like property, plant, and equipment, inventory, land, that type of thing. Okay, it's a non-monetary asset. And these are exchanges of non-monetary assets. They often involve money. Okay, but when they say non-monetary, what they're describing is the asset that they're exchanging, one asset for another asset. Now, this is covered under standard number 153, which is fairly new. It's been on the exam since about late 2005, early 2006, so it's getting a little bit more mature now. So you might have multiple choice questions. Also, when I signed you, remember I signed you simulation number 1, there's a very good problem there for non-monetary exchanges. So what I want you to do is I want you to go over that. I'm not going to do that problem, all right, because I looked at the problem and I looked at the answer, and it's very, very good. The solution is very good, so you can follow along. But I want you to do that one because it has a good example of non-monetary exchanges. Now, on page 6 of your financial accounting reporting handout, it says Financial Accounting Reporting, Module 6, Fixed Assets, Accounting for Non-Monetary Transactions. SFAS number 153, Exchanges of Non-Monetary Assets. This is an amendment of APB number 29, is effective for non-monetary asset exchanges occurring in periods beginning after June 15, 2005. It allows early application for non-monetary asset exchanges occurring in fiscal periods beginning after its issuance date of December 2004. Okay. SFAS number 153, Exchanges of Non-Monetary Assets. This is an amendment of APB number 29. You have to go through these 3 criteria. And it says, does the non-monetary asset exchange meet one of the 3 following exception criteria? You know, I still have dirty glasses. Here we go. All right. Does the non-monetary asset exchange meet one of the 3 following exception criteria? And the 3 following exception criteria are, number 1, fair market values of asset received and asset given up are both unknown. So you don't know anything. Or number 2, the exchange transaction is done to facilitate sales. Okay, they will use that exact language there because that exact language is found from the accounting standard. And it'll say the exchange is done to facilitate sales. If you say that, if you see that in the problem, then you know that they met one of the 3 exception criteria. Number 3, the transaction lacks commercial substance. Now this one, though, you might have to determine on your own. They might either say the transaction lacks commercial substance, or they might say it has commercial substance, or if they don't tell you it lacks commercial substance, they might say that the cash flows do not change in terms of their risk, timing, and amount. If the cash flows do not change in terms of their risk, timing, and amount, then we know that the transaction lacks commercial substance. Or if they say that the cash flows do change, if they do change in terms of their risk, timing, and amount, then we know that it does have commercial substance, okay? Also in letter B, remember you do not include the income tax effects when considering the cash flows. So you ignore the income tax effects. So you either meet criteria number 1, you don't know anything about the fair market values. Number 2, the exchange is done to facilitate sales. Or number 3, you lack commercial substance. You meet any one of those 3 criteria. If you meet one, then you say, yes, the non-monetary asset exchange meets one of the 3 exception criteria. But let's just say, assume that it doesn't. On the far left-hand column, it says, no, the transaction does not meet any one of the 3 exception criteria. If it doesn't meet any one of the 3 exception criteria, then you would use the fair market value, also known as the fair value method. Use the fair value method. And when you use the fair value method, you're going to calculate the amount of the realized gain or loss. Now, this is the same for everything else on the handout. But to calculate the amount of realized gain or loss, you compare the fair market value of the assets given up with the carrying value of the assets given up. You always compare the fair market value of the old stuff with the carrying value of the old stuff. It's what you gave up. However, look at the little